Hello, and welcome to another episode of Williams Mullins Benefits Companion. On this podcast, we provide updates and insights on our employee benefits laws and regulations and trends. I'm your host, Bryden DeWitt, and today I'm very pleased to be joined by special guest Ken Barnes, Senior Investment Consultant with SageView Advisory Group. Welcome back to the Benefits Companion, Ken.
Thanks for having me again, Braden.
Ken, I'm as with each passing year, I'm only in my early to mid 50s. I kind of get more and more interested about this idea of lifetime income products, where we've seen over the last several decades just a decline in defined benefit pension plans, the plans that guarantee retirees a monthly income for life. I think about my great aunt Ruth and great uncle Jim, who worked their working years at Westvaco, and they retired in probably the 1980s with those gold standard defined benefit pension benefits, both of them receiving their benefit. And they had a really comfortable life, right? Until they passed away. They never seemed to have to worry because they had that guaranteed monthly pension. And in today's world, it's more, what have you as the employee saved? Have you saved enough to be able to retire and to be able to support yourself through all of those non-working years? And so that brings us to this, there's increasing talk about lifetime income products. So just to start off, what exactly are lifetime income products?
Yeah, no, and I'm going to use this term really broadly throughout, but at a high level, lifetime income products, they're a solution within a defined contribution retirement plan, like a 401k, that's going to convert a lump sum savings. So let's say you have $500,000 invested in your 401k, and it's going to convert that into a guaranteed income payment during an individual's retirement. So exactly like that pension plan that you were describing earlier. So that lifetime income solutions come in a few different forms. So broadly, you can have standalone annuity products that really provide an income stream in retirement. Those can get a lot more complex than just the income in retirement, but just high level. You have annuities that are part of a target date series. So we've had different target date providers in recent months and over the past few years actually roll out a portion of the glide path that is invested in kind of an annuity product at the back end of the target date series that's going to provide lifetime income for a portion of that individual's balance. You have managed payout products. These are non-guaranteed products that provide a monthly payment similar to an annuity. And then you have managed account products that feature some sort of guaranteed living withdrawal benefit. So broadly speaking, it's a kind of solution set that can go in a lot of different directions.
So it's really, if employees now have defined contribution plans, they don't have that guaranteed pension benefit, but they can basically fund their own pension. They can convert their defined contribution into a guaranteed.
Exactly. Yeah.
And maybe this question answered itself, but why do you think these are needed? Why is there interest in these at this time?
Yeah, and so a lot of what we do and working with our retirement plan clients is actually meeting with individuals. And I think as an industry, we've done a really good job of helping people accumulate assets during their working lives, right? So most retirement plans that I work on right now automatically enroll their participants into some sort of well-diversified investment like a target date fund. Most of these plans actually automatically increase their participants who are deferring into the plan by 1 or 2% a year. And then there's always a lot of great financial wellness resources around saving for retirement. But that being said, when you meet with individuals, the biggest concern you hear is, hey, I've got this lump sum. I've got $500,000. I don't have $500,000 in any saving account. I don't have that amount anywhere else. What do I do with it? And there's a lot of confusion from individuals on how to spend down that money. So William Sharpe, who won a Nobel Prize in economics, he actually described the distribution phase as the nastiest, hardest problem he's ever looked at. So in addition to the needing help for individuals distributing assets, LIMRA conducted a survey that said 35% of individuals have concerns about outliving their assets in retirement. So the fear of outliving one's assets comes at a time where, as you mentioned, traditional pension plans are not really offered by employers anymore. And individuals are living longer at the same time. So this is really the first generation retiring where individuals probably for the most part don't have access to a pension plan. And so the burden is really on the worker to save for their own retirement. But not only to save enough, it's once you have that savings, figure out what to do with it, figure out how to convert it into a income stream in retirement. So retirement income products are really designed to help solve that longevity risk, and then also helping participants create a stream of guaranteed income in retirement.
Yeah, and as you think about it, we can help people save, put money in their 401k plan. You can do the analysis to come up with the target amount. If you have this X dollars in your account by the time you're 65, that money should last until you're 85 or 90. And there are a lot of assumptions of the burn rate, assumptions of the market, how the market will perform over that amount of time. And I can see a retiree looking up and saying, well, yeah, according to on paper, I have enough saved and I'm retiring, but can I really take that trip I want to take to Europe this year? Can I expand the house? Can I make these expenses, these non-necessary expenses, because you're burning your nest egg that you saved? And even though all the assumptions and the analysis can say, yes, you can spend this amount per year, I think just from a human level, if you're looking at it, there's fear.
Yes.
That even it may be irrational fear, but nevertheless, there's fear that you're going to outlive your money, or you're going to burn through it too fast. And an annuity, a lifetime income option, even if it's maybe you purchase an annuity just to cover your basic needs, can give a retiree that comfort and peace of mind that they can spend a little extra on some things they want to do without risking running out of money and not being able to support themselves.
And I think you're exactly right. And if you look at, there are all sorts of surveys out there, and a lot of the large insurance companies like to reference them. But if you look at the percent of people who want some sort of guaranteed income in retirement, most people are going to say yes. And it's really giving them that peace of mind. That's what they're looking for.
Right. So we've had legislation, the Secure Act 1.0 right at the end of 2019, and then the Secure Act 2.0 that have done a lot for defined contribution plans. Really, it seemed like a recognition by Congress that the defined benefit pension days are over, and a lot of more flexibility for defined contribution plans, and really encouraging, the law is helping to encourage people to contribute to those plans. Is there anything with a Secure 1.0 or 2.0 that helps pave the way for lifetime income products?
So yes, absolutely. So both Secure Act 1.0 and 2.0 have certain regulatory or have certain provisions that allow for flexibility for those plan sponsors in adding a guaranteed lifetime income product into their retirement plan. I think one of the things that you mentioned just a moment ago is part of Secure Act, and that's within a individual statement, and this is through, I think, Secure Act 1.0, but participants are now required to see on their annual statements a lump sum, what their lump sum is equated to in terms of retirement income. So participants now, once a year, are seeing how much, if they have $100,000, what does that mean in terms of monthly income? So that's part one, and that's not making it any more flexible or easy for participants or plan sponsors to add. But it gives participants an idea of, hey, maybe that $100,000 isn't as much as I thought in retirement income, or maybe, gosh, maybe that $1 million I have is more than enough that I need for income. But really, the bigger components of Secure Act 1 and 2 that I think paved the way for greater adoption of lifetime income. The first part is there's now a safe harbor provision in Secure Act that is meant to remove a fiduciary's fear that they would have to make a determination on the viability of an insured, on their creditworthiness to provide an individual with lifetime income. So it did so by saying that if a plan sponsor has an explicit process to assess the financial strength and the creditworthiness of an insurance company, that they would essentially receive that safe harbor. Now, Secure also allowed for lifetime income product portability. So prior to Secure Act, the lack of portability was a huge hurdle for plan sponsors looking to add lifetime income products. Because if I'm a participant and I've been contributing into an annuity-like product in a retirement plan, but I were to leave my company, or I were to look to roll it out to an IRA or another 401k plan, there was uncertainty about potential to move that product from one plan to another, and then to move to a plan that couldn't support one of these types of solutions. So with the passage of Secure, participants now have the ability to roll over their lifetime income benefits to other eligible plans. Now, I think record keepers are still working on that, but that option now is available, broadly speaking.
And so maybe that's kind of part of the answer to my next question. But given the attractiveness of lifetime income options, why has the adoption of this been low? Why is there not as much interest in this? And do you think it's going to change going forward?
Yes, that's a good question. LIMRA, they're big on research and kind of in the financial service and annuity space. And they ran a survey, and only 14% of defined contribution plans currently offer an option for participants to annuitize their plan balances. So it is really low currently. I think part of the reason for that is historically annuities have had a negative connotation associated with them, as a lot of individuals may associate annuities with high fees or lots of complexity. But most of the plans that I work on outside of 403(b) plans, and there are reasons 403(b) plans have generally contain annuities, but most of the plans that we work on don't currently offer any sort of retirement income solution. And our clients specifically are taking kind of a wait and see approach right now. With the passage of Secure Act, a lot of products have been released, and a lot have really come to market in the last, I'd say, 1 to 2 months. Our plan sponsor clients have generally wanted to see what the demand is first from their participants. So is there an actual appetite for these type of solutions? They want to understand if the products will actually be portable across record keepers. And then finally want to understand how complex they are for participants to understand, and how complex they might be to administer. So that's kind of the why maybe they haven't been added. But from a whether I think there'll be greater adoption moving forward, I really do anticipate that we'll see a lot of additional interest and demand from plan sponsors starting this year. Secure Act's whole goal was to remove ambiguity around the fiduciary standard and eliminate roadblocks to offering lifetime income in defined contribution plans. So Congress really did remove that roadblock in 2019 with the passage of Secure One. But at that point, there weren't enough vehicles to take advantage of a clear road ahead. So what we're seeing now is with a lot of products being rolled out, I think there's going to be a lot more interest coming from plan sponsors.
And do you think there'll be more interest from plan participants that will drive it as well?
Yeah, I do think there will be, because I think participants really are looking for some sort of guaranteed income in retirement. So something that they understand. And a lot of people really just don't understand how to draw down their large balances. And not everybody has access to a financial advisor or a financial planner who can kind of help them with building an income stream and making decisions about how best to draw down their assets. And so these annuity type products are really going to offer a great solution for those who need help building a retirement income plan.
So let's say a plan sponsor is thinking about adding an annuity product or a lifetime income product. What are some of the things that they need to consider?
So first and foremost, I'd say it's a fiduciary decision. So from that aspect, I think that any retirement plan committee that's considering a lifetime income or an annuity type solution in their plan, that they employ a fiduciary process that's similar to one used to select any investment for the plan's investment menu, but really be mindful of the unique issues posed by these income products compared to like a mutual fund of a large cap growth manager. Obviously, very different types of products, but employing a fiduciary process that's similar to one that you're already using is the first thing I'd say. But next, I'd say really understand what type of product or what type of those, whether it be an annuity, a managed account, a managed payout, a target date solution, what would best align with both the participant and the retiree's needs in your workforce? What best aligns with their investment sophistication and the demographics of your workforce? So really analyze your individual needs, how you may differ from other companies, and pick a solution that fit those needs best. And then the last thing I'll say is when you're adding a lifetime income solution, communication is really important, right? So make sure you're communicating to your plan participants. You don't want to add the solution, have very little uptake, have confusion from plan participants. You want to make sure that you're communicating the potential benefits of the solution, why it's added, and also make them aware that it is an investment option within the plan.
Well, Ken, thank you so much for coming back on the Benefits Companion, and this has been a really interesting topic.
Yeah, thanks for having me again, Brad.
So that'll wrap up our discussion on lifetime income solutions. If listeners have any questions or suggestions for future episodes of this podcast, please contact me. You can also visit our employee benefits page at williamsmullen.com/employee benefits. There you can find out more about our team, as well as past episodes of this podcast and legal alerts. Thanks for listening.